Imagine a business that, prints money so efficiently that the U.S. government is actively trying to dismantle it, right?
Right.
Yet Wall Street is currently pricing the stock like it's some legacy dinosaur just waiting for imminent extinction.
It's wild. I mean, we're looking at a financial landscape today that completely defies standard economic models. Usually when a business scales up, gravity eventually takes hold.
Yeah, you saturate the market, your acquisition costs spike, margins compress.
Exactly. But in the world of global payment networks, gravity just doesn't seem to apply. It is the absolute definition of, like, an apex predator business model.
Right. And welcome to this deep dive. I am your host, and today our mission is to examine the invisible engines of the global economy, really Visa and Mastercard.
The ultimate toll booths.
Exactly. And we've synthesized a massive stack of recent financial data for you listening today. We're pulling from Visa's Q1 2026 earnings, Mastercard's Q4 2025 presentation, a pretty aggressive Department of Justice antitrust lawsuit, and fresh analyst reports from Evercore ISI, UBS, and Investing.com.
Yeah, and look, we are stripping away the generic retail narratives today. We're looking purely at the unit economics, the multiples, and the structural threats.
Because the market is paralyzed by the specific narrative, right?
Completely. And our goal is to determine if that narrative is fundamentally flawed. Because these two companies have effectively decoupled their revenue growth from their capital expenditures.
Which creates a frictionless operating leverage that, most tech companies can literally only dream of.
Right.
So here's the fascinating paradox we're going to unpack for you. Both Visa and Mastercard are generating profit margins that, honestly, look like typographical errors.
They really do.
Yet, because of these existential threats from government regulators and, viral theories about AI and crypto disruption, they're trading at decade-low free cash flow multiples.
That's the ultimate mismatch.
So we're here to find out if these ultimate moats are finally cracking, or if we're looking at the most severe mispricing in the market right now. Let's start by contextualizing the sheer velocity of the capital moving through these networks.
Yeah, the scale is difficult to comprehend until you actually isolate the data points. Look at what Visa just delivered in Q1 of 2026. Net revenue hit $10.9 billion.
Wow.
Which is a 15% year-over-year increase. And their total payment volume for 2025 reached a staggering $14.2 trillion.
Trillion. With a T.
Right. And Mastercard isn't far behind, tracking incredibly close. They posted Q4 2025 revenue of $8.81 billion, which was up 17.6%. Net income hit $4.06 billion, up over 21%.
People always use the toll bridge analogy for these companies, but I feel like that actually understates their power.
How so?
Well, a toll bridge requires maintenance, right? You have to pave the roads. A better way to understand this is to picture a room with 100 million merchants and 15,000 banks.
Right.
None of them speak the same language, and none of them inherently trust each other. So Visa and Mastercard just sit in the middle of that room as global translators. They don't sell the goods, they don't lend the money.
They take zero credit risk.
Exactly. They just translate the transaction, verify the trust in milliseconds, and take a fraction of a percent for the service.
And that translation service yields margins that are, frankly, unmatched in public equities. Because their fees are largely percentage-based, inflation acts as this automatic built-in revenue tailwind.
So as the nominal price of goods rises, their cut just rises proportionally.
Automatically, without them deploying a single extra dollar of capital. Look at the numbers. Visa's is currently running a 97.8% gross margin.
Wait, 97.8?
Yeah, and an 83% operating margin in North America. Mastercard operates with a literal 100% gross margin and generates a 46.66% return on capital.
That is insane.
Earning nearly 47 cents on every dollar of capital deployed makes this an aggressively efficient compounding machine.
Okay, but I have to challenge the sustainability of that. When you're moving 13.2 trillion in volume, the law of large numbers dictates that growth has to hit a ceiling eventually.
You would think so.
Right. You can't compound forever at that size just by relying on consumers swiping cards. So how are they structurally accelerating at 15 to 17%? There has to be some hidden lever.
And that brings us to the contrarian edge of this analysis. The consensus relies on this assumption that these are just credit card networks riding retail swipe volume.
That they're not.
They're not. The hidden lever And the real reason their growth is accelerating is a massive pivot into value-added services, or VAS.
Okay, explain that.
They've aggressively transitioned from simple payment rails into critical enterprise data, software, and cybersecurity platforms.
Yeah, I was looking at the breakdown of these value-added services, and honestly, it reads more like the portfolio of a pure-play cybersecurity firm than a credit card company.
Exactly. Identity verification, fraud analytics, consulting.
But let me push back for a second. Can consulting and fraud software really move the needle for companies dealing in trillions of dollars of swipe volume? I mean, you can only sell so many fraud algorithms to a bank, right?
But see, you're thinking about software as a boxed product. You have to think about it as network intelligence.
How so?
Well, how does Mastercard's fraud algorithm actually work? Because they see trillions of dollars of global flow, their AI can match a physical card swipe at a bodega in Brooklyn with a simultaneous server login attempt in Tokyo.
And flag it instantly.
In milliseconds. They aren't selling generic software, they are selling the aggregate intelligence of global commerce. Visa's VAS revenue hit $3 billion in Q1 2026.
Wow, $3 billion just from services?
Yeah, that's now almost 30% of their net revenue, and it's growing at 25%. Mastercard is even further along, with VAS making up 38% of total revenue, growing at 26%.
And the quality of that revenue is what really stands out in the source documents. It's not just about diversifying away from swipe fees.
The underlying mechanics of that revenue are critical. Mastercard disclosed that 60% of their VAS revenue is network linked.
Meaning it scales with transaction volume automatically.
Exactly. It scales without requiring proportional new capital investment. As a bank's payment volume grows, the amount they pay Mastercard for cybersecurity and fraud monitoring grows automatically.
That is massive, frictionless operating leverage.
It's precisely why Mastercard's free cash flow margin has expanded from the high 20% range a decade ago to 42.3% today.
Okay, but looking at the segment data side by side, I did spot a glaring discrepancy. Visa reported 28% growth in their services segment. Mastercard reported 22% organic growth.
Right.
On paper, it looks like Visa is dominating the services war. Does that mean Visa is winning?
Skimming the headlines leads directly to that conclusion. But peeling back the layers reveals the exact opposite reality.
What's the catch?
Visa's 28% growth was artificially inflated. They had a massive, one-time event-driven volume spike from the Milano Cortina Winter Olympics.
Oh, so it's an event tailwind, not a structural shift.
Exactly. Mastercard's 22% growth was entirely organic. When you adjust the models to an apples-to-apples event-free basis, Mastercard's intelligence and security business is actually compounding faster than Visa's.
That's a crucial distinction. It's the difference between paying for a temporary Olympic bump and paying for structural compounding growth.
Precisely.
But let's follow the logical progression here. When you print 97% gross margins and essentially act as a tax on global commerce, you don't just attract investors.
No, you attract regulators.
You attract the DOJ. You cannot be that profitable without the government assuming you've rigged the game somehow. Which leads us to the September 2024 Department of Justice antitrust lawsuit against Visa. And just to be unequivocally clear to you listening right now, we take absolutely no political stance on government regulation here. We are strictly analyzing the factual claims in the DOJ complaint and what they mean mechanically for Visa's business model.
Of course. So the DOJ's core thesis centers on the U.S. debit market. They allege that Visa controls over 60% of U.S. debit transactions, which allows them to extract roughly $7 billion annually in fees.
Right.
The central argument is that Visa illegally maintains a monopoly by insulating itself from competition through these exclusionary tactics.
And the mechanics of those tactics, as alleged in the complaint, are fascinating. The DOJ claims Visa uses its enormous scale to impose a web of disloyalty penalties.
Basically a stick instead of a carrot.
Exactly. If a bank or a merchant tries to route a transaction through a smaller, lower-priced competitor's network, Visa penalizes them financially. It forces compliance just through the sheer threat of higher fees across the board.
And they have the paper trail to back up that mentality. In the DOJ files, there's a remarkably blunt quote from a former Visa CFO regarding tech startups trying to enter the space. He literally stated, "Everybody is a friend and partner. Nobody is a competitor."
Wow, nobody is a competitor.
That quote is the blueprint of their historical M&A strategy, co-opting the disruption before it scales. Look at the mechanics of the abandoned Plaid acquisition back in 2020.
Visa tried to buy Plaid for, what, $5.3 billion?
$5.3 billion. And why? Because Plaid's technology connects applications directly to consumer bank accounts. That completely bypasses the credit and debit card networks.
Oh, so Visa's internal documents basically showed they feared fintechs with network ambitions would cut them out as the middleman.
Exactly. They tried to buy the threat.
Yeah.
And when the DOJ moved to block that merger, those documents surfaced.
Look, when the government prevents you from buying your competitors and simultaneously sues you for how you handle your existing clients, that legal friction becomes very expensive.
It's a massive drag.
This is no longer just theoretical headline risk. Visa recently had to deposit $500 million into a litigation escrow account, specifically for the multi-district litigation, the MDL case.
$500 million.
Sidelined to insulate the balance sheet from impending legal liability.
The legal moat is definitely sustaining direct hits. But, regulatory threats move slowly through the judicial system. Technological threats move at the speed of software.
Right, which is what is driving the current market panic. Because if the government can't dismantle the translation engine, the fear is that technology will simply render it obsolete.
The AI threat.
Yeah. Recently, Mastercard's stock dropped 6% in a single trading session. Not on an earnings miss, but triggered by a viral post from Citrini Research outlining this severe disruption scenario. Let's unpack the mechanism of this tech threat.
So the disruption theory models a near future around 2028, where AI agents execute purchases autonomously on behalf of consumers.
Okay.
The critical mechanism is that these AI agents would route the transactions through stablecoins on blockchain networks. They'd send digital dollars directly from the consumer's wallet to the merchant's wallet.
Which completely circumvents the legacy Visa and Mastercard networks.
Exactly. Instantly erasing those 2 to 3% interchange fees. And analysts at Evercore ISI reacted to this exact fear. They downgraded both networks, citing concerns over terminal growth and a structural lack of near-term catalysts.
But, let's apply some critical thinking to that scenario. The entire Citrini theory assumes that consumers view the current payment friction as a problem that desperately needs solving.
Which they don't.
They really don't. Every time you tap your phone for a $5 coffee, about 15 cents vanishes into this invisible network. You, the consumer, do not feel it. The merchant feels it.
Consumers actively love credit cards.
Right. They love zero liability fraud protection. They love the ability to effortlessly dispute a charge, the airline miles, the cash back. That 2 to 3% fee is the merchant's nightmare. It is not a consumer pain point.
Spot on.
So why would a consumer switch to a stablecoin that offers no rewards and no fraud recourse just to save the merchant some money?
They wouldn't. And that is the core disconnect in the market's panic. The disruption narrative completely ignores human behavioral economics. Furthermore, look, stablecoins are highly efficient data structures, but they're not standalone economies.
You still need an on-ramp and an off-ramp.
Exactly. You still have to pay taxes, buy groceries, settle mortgages in the traditional financial system. Visa and Mastercard are not merely payment rails. They are the fundamental trust infrastructure of the global economy.
So the thesis that they're going to war with stablecoins is inherently flawed. They're just absorbing them.
Precisely. And the data validates this absorption. Mastercard has already facilitated stablecoin card issuance in over 50 countries globally.
50 countries?
Yeah. In Q1 2026 alone, they integrated 9 new countries into that ecosystem. Look at SoFi. They recently partnered with Mastercard specifically to settle their SoFi USD stablecoin across the Mastercard network.
So the blockchain provides the ledger, but Mastercard provides the trust and the merchant acceptance.
Exactly. Stablecoins are currently driving new partnership volume, not cannibalizing their existing swipe volume.
Here's the real question nobody is asking, though. Everyone is obsessing over consumers using AI to buy sneakers, right? They're completely ignoring the enterprise side.
The B2B market.
Yes. The consumer payments discussion dominates every analyst model, which means a $100 trillion total addressable market is being entirely ignored in consensus valuations.
The B2B market, specifically high-margin cross-border corporate payments, is the actual battleground here. For decades, massive corporate transfers have relied on the SWIFT network.
Which is notoriously slow.
Slow, carries high friction costs, lacks real-time transparency. So Mastercard developed a platform called Move, to directly replace those clunky wire transfers. It enables banks to execute real-time cross-border corporate payments.
And the volume numbers actually reflect that transition. Mastercard's cross-border volume grew 14% in Q4.
Outpacing Visa's 11%, yeah.
So the very segment that theoretically faces the highest disruption risk from blockchain efficiency is simultaneously their fastest-growing, highest-margin segment.
Exactly. If the blockchain disruption thesis were actively destroying their moat, cross-border volume would be cratering right now. Instead, it's accelerating.
It's crazy.
And that brings us to how we reconcile this massive gap between the market's panic and the underlying financial realities. We are looking at an exceptionally rare mispricing.
Let's look at the multiples on that. Despite carrying a Benzinga Edge quality score of 92.76, which, flags exceptional operational efficiency and balance sheet health, both stocks are trading at historically compressed multiples.
Very compressed.
Mastercard is sitting at roughly 28 times price to free cash flow. That's a decade low for a business compounding at this rate. The free cash flow yield is around 3.62%, which are levels we haven't seen since the depths of the COVID crash.
It's an incredible setup.
But, okay, I will play devil's advocate here. I am looking at Mastercard's Q4 presentation, and management just announced a 4% workforce reduction alongside a $200 million restructuring charge.
Yep.
Usually, when a company starts cutting headcount and taking massive restructuring charges, it signals internal panic about future growth. Doesn't that signal trouble?
Applying a legacy industrial mindset to a 2026 data platform yields the absolute wrong conclusion.
How so?
This headcount reduction is not distress. It is the mathematical proof of AI-driven operational leverage. Consider the unit economics they just reported. They are generating 17.6% more revenue while operating with 4% fewer people.
Oh, wow. So they are actively compressing their legacy cost base using internal AI tools and just funneling that capital directly into their high-margin, value-added services?
Exactly. The $200 million charge is just a one-time accounting hit against a quarterly EBITDA base of $5.38 billion.
A drop in the bucket.
They earn that money back in annualized cost savings in a matter of months. They are eliminating undifferentiated operational drag and reinvesting heavily into their cybersecurity modes. It is textbook, aggressive capital allocation.
Right.
And if you want confirmation that this is the correct read, look at the insider activity.
Because institutional confidence is one thing, but what the executives are actually doing with their own compensation tells the real story.
Always. On March 1st, 2026, Mastercard CFO Sachin Jaimera executed a series of stock transactions. If an algorithm simply scrapes the SEC filings, it flags shares being disposed of, which triggers this narrative that the CFO is selling at the top.
Right, algorithms just see sell.
But the underlying mechanics of the filing reveal the truth. Those dispositions were strictly mandatory tax withholdings for vesting shares.
Oh, so the nuance completely changes the signal. He isn't cashing out.
Far from it. The net reality is that he received over 18,000 earned performance stock units that fully vested at a $512.76 price point.
18,000 shares.
And these units required 3 years of sustained, rigorous performance metrics to even earn. Holding them signals a massive structural commitment by the chief financial officer to the company's valuation at current price levels. He is maintaining massive exposure, not abandoning ship.
That is a huge signal. So let's synthesize this analysis for everyone listening.
No.
We started by challenging the assumption that Visa and Mastercard are simply legacy credit card rails vulnerable to terminal decline.
Right.
Instead, we found two companies rapidly mutating into high-margin cybersecurity and global data behemoths where 60% of their new services revenue scales effortlessly with volume.
The invisible moat.
We examined how their 97% margins have drawn the aggressive scrutiny of the DOJ, dissecting the exclusionary tactics that maintain their U.S. debit dominance. We stress-tested that viral panic surrounding AI and stablecoin disruption, revealing that these networks are actually absorbing the technology to become the trust layer for the crypto economy. And finally, we highlighted the profound disconnect where companies compounding free cash flow at 17% are trading at decade-low multiples while actively expanding their operational leverage.
If you remember one thing today, it is this. The market is currently pricing these companies based on a completely flawed narrative of imminent retail disruption.
Right.
The underlying data proves they're accelerating into high-margin enterprise platforms, capturing that ignored $100 trillion B2B market. The 1,400 basis point expansion in Mastercard's free cash flow margin over the last decade is the empirical reality. The AI disruption narrative is just noise.
It is the ultimate mismatch between media narrative and actual unit economics. And as we conclude, it leaves you with a final, lingering question to consider as the financial landscape shifts beneath our feet. As we move toward a future where autonomous AI agents execute invisible micro-purchases on our behalf, communicating seamlessly with blockchain networks, will the bank logo stamped on your physical piece of plastic even matter anymore? Or will the ultimate winner of the next century simply be whichever invisible network possesses the most flawless, unhackable security algorithm? Thank you for joining us on this deep dive. Keep questioning the consensus narratives, relentlessly check the underlying data, and above all, pay close attention to the invisible forces shaping your wallet.